Hello, everyone, and welcome to today's Blockworks webinar, Yield Generation, North America versus Asia. I'd like to invite our speakers to unmute their lines and turn on video. During the webinar, please submit your questions to our speakers through the chat function in Zoom. We'll save some time at the end of the discussion to answer these. The session will be available on demand, and all registrants will receive an email once the recording is live. I'd now like to turn the event over to Mike Ippolito, Blockworks co-founder. Mike, please go ahead.
Awesome. Thanks, Jane. Excited to be here, everyone, and to talk to you about everyone's favorite subject in crypto, which is yield generation. Before we get into it, I do want to do a quick shout out to the session sponsor, Matrixport, represented here by Cynthia. For those of you who don't know about Matrixport, first of all, congratulations on your successful raise, $100 million at a $1 billion valuation. At Blockworks, we have a little tradition. We do a round of applause, so no one else can see me, but everyone give Matrixport a big round of applause. A couple of words about them. They are the fastest growing digital assets platform based out of Asia, over $10 billion of assets under management. And they're really a one-stop shop for everything crypto, right? So you can buy, hold, trade, get yield against, a whole bunch of different really interesting things. I highly recommend you go check them out at matrixport.com. Awesome. Now, if we could just get started with a super quick round of intros. Cynthia, because I just gave such intro to Matrixport, I'll pick on you to go first.
Thank you for the comprehensive intro. I think you did most of my job. So I just want to say hi to everyone who dialed in today. I'm based in Hong Kong. It's nice to be here tonight and to speak about some of the products and opportunities that we see in this industry and especially in Asia. Thank you.
Awesome. Thanks, Cynthia. I'm just going to pick on folks as they appear in the order on my screen. So Mr. Bill Barhydt, you want to do a quick intro?
Yeah, sure. Good morning. Good in the world. My name is Bill Barhydt, founder and CEO at Abra, normally based in California, happen to be in New York. We are a for trading, earning interest and yield, borrowing against crypto assets. We service retail customers in a country with our Platinum platform, and so we trade about 150 different crypto assets, allow you to generate anywhere from 4 to 10% yield on crypto deposits. And now we provide both retail and institutional loans against crypto holdings as well. Happy to be here.
Thanks, Bill. Leon, you want to go next?
Yep, sure thing. First of all, thank you for the invite. I'm a big fan of this Blockworks series, and so it's an honor to be here. So I work for Genesis. So Genesis is a principal sell-side broker operating in the crypto space since 2013. We're focused on prime services, and we have 4 main pillars of our business. So we focus on trading, lending, borrowing, derivatives. We also have a custody arm. We're located around the world. So we have offices in London, Singapore, and New York. Our sister company is Grayscale. That's the largest asset manager in the space. Our other sister company is CoinDesk, who I probably shouldn't have mentioned, but one of the largest events and media companies in the space. DCG Foundry, one of the largest mining pools, the 4th largest mining pool in the space. So I'm a reformed commodities trader and PM. Now I lead the sales team at Genesis, and yeah, a delight to be here.
Awesome. Thanks, Leon. And last but certainly not least, Mr. Jason Urban.
Hey, thanks for having me. This is really a great little series you guys put together. Galaxy Digital is a full suite financial services company inside of crypto, and we do everything from investment banking to trading to prime to asset management as well as principal investing. And one of the things that I'd just like to touch on today is the fact that we really can do it all, just like our other people here that are on this. Everything from yield generation to helping you raise money and helping you get into the space.
Absolutely. Thanks, guys. So with that, thanks for those round of intros. Let's just get into it. So today we're going to be talking about yield generation, and we're going to draw a bit of a distinction in the latter half of this webinar in between kind of yield generation as it works in the Eastern versus Western markets. Also keep in mind, folks listening, you're going to have 15 minutes at the end to do audience Q&A. So you've got 4 very, very smart people on the line here. So make sure to get your questions in as you're listening to the webinar. I just want to start this off kind of broad, and then maybe we can start to zoom in on specific topics. But you guys probably get this all the time, but one of the things that I get asked from folks outside of crypto all the time is, how are these yields that I'm seeing possible, right? Especially in this macro environment of super low interest rates and low yields. You see these things in crypto, it's like double-digit yields or even higher. And a lot of people's first reaction is, how does that even work? So from a very high level, what are some of the structural things within crypto in general that allow for those high yields?
Yeah, maybe I can take the first try. Yeah, so crypto is not fiat, so it does not have a native interest rate, but there has been various ways to extract the yield from the crypto market. In fact, like including Matrixport and some of the participants here tonight actually have products on their platform that actually help their clients, retailers or institutions, to gain exposure and earn yield from the crypto markets. So the first common way to earn yield is lending and borrowing, which actually takes form of collateralized loan, credit loan, or margin lending, which is one of the typical prime services. So the lending market actually has emerged in 2019 and actually become one of the 20 to 30 billion outstanding loan size as of today. And we also start to see this market become more mature. We see the formation of a more like interbank sort of like market structure, where institutions actually take or provide liquidity to each other. And also we have seen the forward curve, especially 1 month or 3 months, being discovered through in the markets through this way. So by the constant lending and borrowing in the market, there has been like yield provided to the user who deposited into product like this. Another way to generate yield is option strategies. The implied volatility of cryptocurrency is fairly high, so you can get I think last year the 30 days annualized volatility for Bitcoin, I think it's more than 100%. So you can earn a pretty decent yield by selling options and collect that premium. Yeah, I think that's some of the typical opportunities that we see in this part of the world.
You know, to add on that, and Cynthia's spot on, I think the key thing to kind of understand is this is an asset that's a bearer asset. And so in order to trade, whether that's on multiple exchanges or do other things, you need to have that asset. And so people want to borrow and need to place it, you know, to trade, to do other yield generating strategies, and therefore that borrowing market is robust. There's obviously option strategies, and then there are structural things within crypto. I know Leon mentioned before Grayscale, that was an arbitrage that was available to people for a long time, as well as basis, where people would take coin and sell futures. And so there were other things that were ultimately driving that and then driving the demand for coin. And so when you think about that, the strategies that happen are really why people are willing to pay. These things don't just exist out of nowhere, and it's incumbent on all of us to help facilitate that for our clients. I know that's something that we're very focused on.
Yeah, I just to add to what Jason has said there, in terms of facilitating this yield, like the way I like to think of it is there's the CeFi space, there's the DeFi space, and then there is the interaction between the two. And, you know, Genesis, Galaxy, Abra, Matrixport are operating rather in the CeFi space and the CeFi to DeFi space. And so like in CeFi, you can just lend to us, right? Or you can do the basis trade for us. You know, these are very much things, you know, there's an exchange, there's a futures market, and you can get the yield. And then separately, there are DeFi native things you can do, right? You can stake, you can do liquidity partner, you can do farming, and you can operate with certain protocols to take advantage of this, like Yearn. And then there is a super interesting space where you can work with a company like Genesis to take advantage of the yields in that DeFi space, right? So you can borrow from us and apply it to a protocol. You can hedge your impermanence loss where you're short volatility through us. You can get, you know, leverage our balance sheet and be a liquidity partner in those pools. And so operating between those two spaces, I think, is going to be an increasingly interesting area. And then, you know, we can talk about this later, but effectively all we're really doing by generating yields is transferring risk from one type of participant to another type of participant. And what these networks allow is that they allow like a permissionless arena for the transfer of risk, whether you want to buy something or sell something or lend something or borrow or whatever it is. And as that arena becomes larger, that CeFi to DeFi space becomes larger, and the opportunities to make yield grow from that just alone.
Leon, could I call on you to expand on that point a little bit? Actually, that idea of transferring risk, I think, is really interesting. To make it a little bit more solid, can you give an example of like what are some of the types of risk that you're transferring, and who are some of the participants that you're kind of transferring it between?
Yeah, I mean, there's many types of risk, right? There is like liquidity risk, there's settlement risk, there's credit risk. There's like first, second, third order derivatives risk, right? Whether it's you're hedging flat price or hedging gamma or some type of derivative or second, third order derivative. So all the time, all we're doing by being a centralized counterpart is just transferring risk from one person to another. But sometimes, to Cynthia's point, like you can get paid for that, right? So you can sell options and get a yield on the options that you're selling, right? You receive some dividend-like instruments around it, and then you have other types of risk. And then, so for example, in this particular case, if you just sell a put, yeah, you still have flat price risk beneath your downside strike. And so what we're basically seeing right now is when someone goes to a DeFi protocol and becomes a liquidity partner and gets insane aping yields, they're actually exposing themselves to different types of protocol risk. Like, guess what? You suddenly get rug pulled one morning, or what you say is, I'm gonna expose myself to protocol risk where maybe there's a bug in the software. So you can get these yields, and by yields, I'm basically defining yield as like some expected return or ex ante return on like a security. You can get these yields, and then you can get comfort around what risk you're taking within that. And so when folks work with companies like ourselves, they can say, look, I'm comfortable with Genesis's regulatory risk and credit risk, and I'm going to get X yield on the asset that I'm lending to them or the instrument I'm operating them with. And then at the same time, there's a whole DeFi space where you can do the same analysis. And maybe Cynthia can speak to this a bit more, but I think one of the distinctions between East and West is, what is your comfort around regulatory risk and what is your comfort around credit risk? And I think in Asia, certain types of clients and certain types of client segments have different risk tolerances. And that's why you get some of these different ways of interacting with CeFi and DeFi.
Yeah, I think maybe, Michael, just to chime in on retail, just to put it in very, very simple terms, because I think there's a lot of retail folks here on the line. We look at it in our risk committee in terms of three types of risk as it relates to the risk management model that we lay out for our board. Speculative risk, right? Which, that kind of, to me, is somewhere in between yield generation and making a bet on what's going to happen with an underlying. And so we use that. Well, we know, but many in this whole kind of yield generation world actually take speculative risk. And this so-called arb trade it's not an arb trade, right? You're making a bet on underlying premium that's going to go in a certain direction. And I wish people would stop calling it an arb trade. That's number one. So number two, we have just basic counterparty risk. What are the chances that this counterparty is going to pay back a loan? Okay. And then three, because crypto and DeFi work differently, and we actually use DeFi for a significant part of our yield generation, how do these contracts work? Who does the code audit? What is the technology risk that we're taking that some new contract will suck out all of the tokens that are in that contract and disappear, right? And so there's this third layer of technology risk that, I come from fixed income. You don't have technology risk for the most part when you're dealing with fixed income assets. You do, duration analysis and convexity analysis and interest rate analysis, and you have a yield curve, and it tells you what's going to happen if interest rates move. That's not what's going on. This is a supply and demand modeling for, basically against all three of those different types of risks that I'm talking about. And in our opinion, it risk and technical risk as it relates to DeFi. Hopefully that technology risk will go to zero over time. But unfortunately, we're also in this mode where a lot of speculative risk is making its way into for yield generation, which shouldn't be the case. Anyways, how retail yield is being generated via kind of all three risk levers.
Yeah.
Just want to add on to like what Bill and Leon has just mentioned. I think DeFi is particularly interesting since the last DeFi summer, we have really seen DeFi as an alternative way of generating yield outside of the centralized way of generating yield, as we just mentioned, especially with the increase in the total value locked. I mean, this pool of liquidity actually does generate a significant part of the yield, and it's power some of our yield product as well. So there's one interesting product which we call it a DeFi product, but actually DeFi product. So that's become immensely popular since we launched it last summer. Is that we help the retail users or institutional users to basically to streamline the liquidity mining in DeFi into like basically one click. That essentially means that we are taking care of some of the risks, try to lay off some risks from the users. This risk include operational risk, because now we have a professional product management team to help them to interact with the DeFi protocols and basically sell the assets. These are all like done by the professional people. So the operational risk definitely minimized. And the other type of risk minimized is that we will have a security team basically to prevent this liquidity pools and the protocols, the smart contract, before we ever deploy the fund into it. So I think this centralized platform getting yield from the DeFi space is becoming a variable theme, and I think it's something here to stay.
Yeah.
So Michael, just one point, the one risk that we didn't mention around DeFi is regulatory, right? So at the end of the day, we all have to be very cognizant of AML KYC and how you interact with these protocols. That's something that we work very hard on. I know there are other people out there working on similar solutions and finding ways to work with regulators to unlock DeFi, because that truly is a major force in what all of our businesses do. And so I think that's very important when you look at that, to understand who you're interacting with and how you're interacting with that, and making sure that you're dealing with institutions like ours, like the other people here, who are being thoughtful around that.
Yeah, absolutely. And we're big believers in DeFi as well. We're actually hosting the largest DeFi conference called Permissionless, shameless plug, in May of next year. I've got a couple of questions for you guys. So Bill, you kind of mentioned this very popular, maybe it's not an arbitrage, but certainly a trade that was getting put on as a way of generating yield, which was the grayscale arbitrage that people talked a lot about. Leon, you were talking before about kind of the basis trade, which is arbing the difference between the price of futures versus spot. So you're kind of selling short the futures and collecting that premium. Those were very popular trades that for various structural reasons no longer really exist. So most of you are in kind of the yield generation business. So what are some of the new strategies that folks are using to generate yield? I know, Cynthia, you were starting to allude that in DeFi, but if you guys could just talk in broad strokes, like what are the kind of popular trades or categories, or however you would define it?
Yeah, I mean, for us, we're very heavy into DeFi right now. I mean, earlier this year, the demand, we all know that the demand for
I think
whether it was miners expansion or exchanges looking for dollars for leverage, whatever the case may be, the demand for dollars is obviously just raw dollars has subsided a little bit, and the DeFi rates that you can generate are still very high. The challenge is knowing how to allocate, right? And that's where the CeFi to DeFi kind of model, I think, is really interesting right now, because most of the people on this line, I suspect, would probably just throw up their arms and punt on this idea of being able to navigate myriad DeFi contracts and opportunities to generate yield, right? How do you manage daily liquidity when you're paid out in altcoins, for example, right? And so that's beyond I think, the capability of most people today. But if you have an experienced team, and it's relative in crypto what experience means, but if you have a relatively experienced team that can manage those contracts and has done, you know, months of testing like we do on any new opportunity, when it's possible. Some of these opportunities don't even last months, but then you can extract very reasonable yield at a much lower risk than if you were to just go it alone and start blindly allocating, you know, Ethereum and USDC to different DeFi contracts and expect a 40% yield over a 12-month time frame, which I can almost assure you is not going to happen. As a matter of fact, when we talk to users who go it alone, actually the majority lose money. And so that's pretty much the opposite of what most people expect when they're going into DeFi. But if managed correctly, it is profitable right now from a yield generation perspective. But like I said, we audit contracts, we look at code, and it takes a long time to do that, and with a lot of expertise requirements. But that's probably the most interesting thing we're seeing right now. We're seeing a lot of miner expansion in the West, which I think is really interesting for obvious reasons, given what's going on in the last few weeks. That's creating a lot of demand for dollars, and I think will for another couple of years. I think it's going to take 18 months. It could take 18 months for the hash rate to catch up. And if Bitcoin stays anywhere near the prices are at now or goes higher, which I suspect it might, then, you know, the demand for mining equipment and transformers and capacity and all the things that go with it is going to explode, and that's going to create even more demand for dollars. So and with all those folks sitting on Bitcoin, it's creating very interesting yield opportunities as well. So I think there are some opportunities that are going to stick around for another couple of years at least, and it'll, you know, things will change. If Bitcoin price screams higher, the demand for dollars for leverage is going to go up again. It's just common sense. So I think we're going to see, you know, lots of different levers being pulled and pushed over the next few years. And, you know, I think it's going to be a really exciting time to see how this plays out.
Maybe I can sort of chip in on the back of what Bill has said. So I think we have to distinguish between yield in a bull market and yield in a bear market, and I don't know if we're in a bear market, but yield when things aren't pumping every day, and we're pretty much
you can say bear market. That's
okay. I know, I don't want to go on the record saying that, but yield when things aren't going crazy, and
pretty amazing when you can say it's in a bear market when you're at 38,000 Bitcoin.
Right. Yeah, I know.
It's actually, on one hand, that's kind of awesome.
Yeah, no, that's right. That's right. Yeah. And so look, I think in a bull market, it's pretty clear, right? It's there were, you know, as you know, people have mentioned before, you know, the disconnects between private placements and secondary markets, the basis trade, and then when things are, you know, not quite as sexy and exciting, you have new types of yield strategies that emerge, of which systematic put selling and option selling and vol selling is one. But secondly, what we find is for folks who are long tokens, right, so non-US dollar denominated yield, they can lend those tokens to Genesis. One reason why they can do that is that we offer borrow on locked tokens. And so if you're a treasury, if you're an endowment, you have tokens, you want liquidity, we can offer it, and other folks who have that token can get yield on it. But a third is exactly what Bill just mentioned, right? So, you know, we run the largest mining pool in the Western world, and a lot of the dollar demand that we have will come from folks looking to do machine financing through DCG Foundry. And then maybe a fourth is to realize that, yes, when prices go down, the basis trade sort of dries up, but you can very easily get reverse basis trades where folks borrow Bitcoin and go long futures. And for those who are holding Bitcoin, that can be a source of yield as well. So, you know, it really depends on what market regime you're in, but I think it's quite easy to see that there are interesting things you can do in each of those regimes.
Yeah. Not to zoom out far here, but I actually love the distinction that you just drew there. So we probably maybe like 6 months ago now, man, time is really flying, had Sam Bankman-Fried on one of these, and it was a very different market regime for crypto. I'm not going to say bull market, it was happy times. But basically his explanation for that question that I started this webinar off, what are the structural kind of things in place that allow for really high yields? You know, he answered in a very simple way, which is that everyone thinks the price of Bitcoin is going to go higher. And that's a very simple way of saying, like, that very simply explains kind of the basis trade, right? That's why the price of futures is ahead of spot, and that allows for different types of yield generation opportunities. It's really interesting for me to hear that a lot of the yield that you guys are finding these days is coming from DeFi, because a big part of yield generation is actually about growth. Like if you take the analogy and look at traditional financial markets, part of the reason why interest rates are so low and therefore there are so few yield generation opportunities is because of a lack of growth in those markets. So, and if you contrast that with crypto and even various sectors within crypto, it's growing incredibly quickly. I'm sure all of you guys feel it working in the industry. It's like you can't hire fast enough, you can't invest enough money. There's this real quick pace of growth. So I guess my question to you is, using that distinction that you just drew, Leon, and like anyone feel free to answer this. I mean, how important is this idea of growth to being able to find and generate yields in crypto? There's obviously risk management, that's one part of it, but how important is the idea of growth, and how does that lend itself to generating yield?
Maybe I can give it a try. I think yield is a byproduct of two things. One is the price volatility, the other is price outlook. So the supply to lend and the demand to borrow will decide the equilibrium price, which is the yield that we see as an end result. So, so for example, in Q1 and Q2, we see everyone is borrowing like borrowing US dollar stablecoins, because they feel because the price is rising, right? So for the Bitcoin miners, they're happy to believe that the price will keep rising and they ramp up their capital and invest into their operations, which give rise to a good yield on collateralized loan, for example, and on the back of it, the fixed income investments, for example. And for the speculators who believe Bitcoin price is going to go a lot higher for the next months, they will be the buyer. There will be more buyers than sellers on perpetual swaps and futures on the exchange. And then that drove the market into contango, and which drive up funding rates and basis, the positive basis. And for hedge fund as well, I mean, they're getting higher yield through this basis trading, and in return, they're more eager to borrow, and they could even afford a higher rate of borrowing. And so all this has been, we've been seeing all this has been like coming to a reverse after the May correction. Then afterwards, I mean, from what we see on our lending desk is that we have seen it's a lot quieter on the USDT, and the fixed income type of yield across all platforms has come down quite a bit. It's still decent. It's still decent compared to some of the alternatives in the traditional market, but it's not as crazy as like 12% or 10% as 2 months ago. But we're also seeing the rise of the DeFi. I think now we see altcoin borrowing requests every day, really every day. I mean, so that means there's has been like growth there. I tend to believe there has been some like DeFi fund who basically are doing a lot of DeFi mining in this market, and on the back of they need to hedge their do delta hedging. So they're basically borrowing the DeFi coins and short. That's my sense of it. I feel probably some of the market players, institutional market players, are doing that. That's why we have seen really sizable like DeFi requests since June, July.
Yeah, to kind of build on what Cynthia said, she talked about the volatility of the asset and price outlook for speculators. I think one of the big driving factors is friction between liquidity pools. And you have traditional people with lots of dollars at a very low interest rate, very easy to borrow. And you have all of us in the crypto space for a variety of reasons. There's been difficulty getting cash. The rails aren't as smooth. You can come to places like Galaxy and we can help with that. But at the end of the day, that's one of the things that mismatch that drives yield. And part of that is growth, right? There's such a demand to pick up on your point, Michael. There's such a demand for assets in this space to do the things, the hiring, the building. And at the end of the day, there's not a lot of easy rails to get those deep pools that are in the traditional finance here. And so, you know, firms like all of ours specialize in that, trying to find ways to get traditional institutional investors to feel comfortable to take the step. They know they have a trusted partner that's doing things appropriately from a legal reg perspective, that's capitalized sufficiently, transparently. And so that's really where you start to see these yields. As more dollars are able to flow in, as more fiat is able to flow in, I think you'll see fiat rates naturally decline. Same thing on the digital side, right? As people unlock that, you know, find ways to unlock those assets in a responsible way, you're going to see rates there decline. That doesn't mean that there aren't going to be yield opportunities. They're just going to be the new development and the new innovations that are going to drive that.
Yeah, I think maybe just to add on what Jason said, I think, you know, firms like Galaxy, firms like Genesis, you know, we're definitely looking to build those institutional rails, which will bring in more dollars into the crypto ecosystem. And I think that's in particular a development that's happening in the West, and with traditional institutional asset allocators. To your point, Michael, but how those yields come lower, to me, I'm not so sure about whether that's a straight line yet. And the reason why is, like Sam, I think Sam said, and I don't want to misquote him, but I think he might have said that there might be, in a bull market, up to, you know, maybe up to $1 trillion worth of leverage of folks saying, hey, this asset class is going higher. I want more exposure to it, and I want to borrow. And I think, and I don't want to misquote him, I think at the time he said something like, and there's about $500 billion worth of demand ready to satisfy that, and the delta of $500 billion where that's why we see rates go up. And that mismatch in those high rates attracts, you know, macro discretionary funds and other asset holders who look at the space and say, hey, this is an opportunity to get some yield. So I think what we're beginning to see now is a lot of those funds, you know, I speak to myself, and I'm sure everyone on this call speaks to, are saying, look, I want to get the pipelines and the rails in place so that if that happens again, we can take advantage and take advantage of that alpha. But I think what you're also seeing is that as those funds get involved on those alpha plays, I think there are some conversations that happen around having beta exposure as well. Let's get along this underlying, because the more tier one investment banks and the more crypto, the more discretionary traditional funds that get involved in the space, the more de-risked it becomes for portfolio managers, the easier it becomes to say, well, look, let's have a small allocation. Let's do it via options. Or if we're making 20% annualized on this $100 million, let's put $10 million of that and buy a call spread and see where that goes. And so I think that and then when that happens, the consequence of that is that more people get more bullish about the space, and the demand for leverage goes even higher. Right. So I think it's not entirely clear to me, as the space goes higher and as those rails open up, whether they open up at the same rate of the demand for leverage in the next bull swing. And that will be exciting to see, you know, and obviously the folks on this call will be central to looking to allocate that capital.
Yeah, but the levers are changing in real time, right? So earlier this year, the two big levers were the amount of Bitcoin going into the trust, the GBTC trust, and also Asian futures markets, right? Where, you know, Americans are mostly shut out, but the leverage is huge. And now it feels like a lot of the money that was with less leverage, a lot of the money that was going into GBTC is now going into wrap Bitcoin, and explicitly for the purpose of, you know, looking at DeFi farming opportunities, but again with significantly less leverage. Now, if that's true, that actually could act as a really interesting floor, because over leverage acts as a really interesting ceiling, right? So if we're under levered on all this wrap Bitcoin going on right now, and not as much money is flowing into GBTC, it's a different set of levers than what we had 6 months ago, with also a different amount of leverage applied to them, which I think, you know, again, so the equation itself has changed. And I think it's going to continue to change because the crypto space in general evolves so quickly that the equation that we used in December, January, February of this year is not the same equation anymore. Right. And it's going to continue to evolve in real time as we're having these same discussions. And so if we have this discussion in 6 months, I suspect it's going to be very different. We don't even know how, you know, NFT world is going to interoperate with Bitcoin, or as DeFi makes its way to the Bitcoin blockchain, what's going to happen? We have no idea. Nobody's really done it yet at any kind of scale. So all of these other banks, there's a question here about, when are the banks going to get into this? And I have strong opinions on that. They're a non-factor. So the equation itself is going to change as we go, right? Not just the levers within the equation.
Yeah, absolutely. And guys, I just want to take this opportunity again to remind those in the audience, we've got questions starting to stack up. So folks, we're going to start taking questions in about 10 minutes. So make sure to load those in. And I actually want to start. So that was really great point, Bill. And I want to kind of start to move this in the direction of what are some of the levers that are going to be used to pull capital into this space. Leon, you just described this, and I love, honestly, if you look at each one of your businesses, Matrixport, Abra, Galaxy, Genesis, those are all, and pretty much every big business that has been built in crypto so far, it is a on-ramp, right? In one way, shape, or form, you are moving fiat into crypto, and huge, really successful businesses have been built. And there are kind of different ways. There are different attractions for that capital, right? We're talking about yield on this webinar, so I want to kind of focus on that. We do have one question from the audience, which is, when will deposit-heavy institutions like credit unions ever use their cash to earn yield in stablecoin markets, right? Because if you're looking at the yield that's offered from like a money market fund versus the yields that you can earn on a lot of people's platforms on this call, that's a huge delta, right? So when do some of those more regulated kind of big institutions start taking advantage of that?
Well, we're U.S. retail heavily focused. Let me try that first. So two things, and actually relates to your earlier comments about what are the levers going to look like in the future. So for us, the way we look at it is right now we're in that on-ramp phase, but eventually we get to this point where everybody is going to want to hold an appreciating asset and borrow in the depreciating assets, right? Meaning if the dollar and the euro depreciate forever, and the best thing that could happen to us is they don't die, but they continue to depreciate, right? Let's be honest. I mean, that's the basis for every business on this call. And at some point, people are just going to borrow against those assets, right? We launched a 0% interest loan product with a 10% LTV, and the demand for that has been through the roof, because there's a certain subset of the population that recognizes now that they want to continue to hold that appreciating asset. That represents two problems vis-a-vis that question that the participant just asked, right? Banks don't look at it that way. That's problem number one. And two, right, until NCUA and the FDIC are willing to insure those deposits, it's not going to happen, right? So, but the irony of that is our space, I mean, the lending part of our space, not trading, not prop trading, has way less leverage than the traditional banking system. Okay, way less, right? The way mortgages are packaged and sold, and the banks basically are way over leveraged compared to, like, for example, how Abra would operate, or Prime Trust, our trust bank partner, would operate in this space. And that's not going to change anytime soon. And that's the irony of all ironies in this space. But I think that the bottom line is that the key lever here is, at what rate is the population going to intuitively get that you hold Bitcoin or Ethereum and you borrow dollars, right? And I think there's going to be 1 billion people that get that, the way Indians would hold gold today, for example, over the next 10 years. And if that happens, there's simply not enough crypto to go around. Bitcoin and Ethereum to go around. And that's the way we look at the banking equation. And then at that point, the banks have no choice but to get on board, no choice.
Well, regulation is key to that, though, right? I think that the banks would be here yesterday if they, and I can speak for us. We have conversations with many of them on a regular basis, on a daily basis. And the biggest issue that they have is regulatory clarity, right? What is allowed, what is not allowed, what's the look back going to be? So that's when you get regulatory clarity, that's when I think you see large financial institutions step into this and start to understand it. And that's why I made the point before about DeFi, understanding what you can and what you can't do and how to responsibly access it in a way that doesn't jeopardize, because while the space has been significantly de-risked from a career perspective, from, when we all got into this, 5, 6, 7 years ago, it's different now than it was then. However, it's still from a big bank perspective, there isn't a lot of clarity. There hasn't been clear lines. We don't even know which of the alphabet soup in Washington, D.C. regulates this. And until we get that, I don't think you're going to see a credit union or a big 4 bank or somebody jump in with both feet. But when they do, they bring to bear considerable assets. And to your point, Bill, at that point, I think there's not enough crypto to go around for the demand that's going to be generated by opening those rails.
But Jason, I would also say for purposes of big bank retail, at least as it relates to this discussion, there really is no difference between a government and a big bank, right? They effectively operate as one and the same, with the government being more the dictator and the bank being subservient, but effectively they operate as the same. It's not like they're making decisions in a vacuum, one or the other. The government and regulators have employees on site at those big retail banks doing, oversight on the fly as they go. And so it's going to take at least 5 to 10 years for those banks to be in a position to operate in our world the way we're operating today. I mean, look at the pain that Silvergate has to go through and the incremental oversight that they go through to operate in our space as a small bank, right?
My take here. Oh, go ahead, Sam.
I actually want to take this opportunity to ask a question that I personally want to know. Is that recently we have seen on the news that in the US there's going to be like cross-agency regulation. Seems that SEC, CFTC, IRS, FinCEN, and Congress, they all want a piece of crypto oversight, right? So I think this is something I want to understand more, like from some of these panelists today, is that what does that actually mean to the players and also some of the potentials we're talking about? Does it mean that when this happens sooner, it's better to the industry, that the banks can be in sooner, where we basically solve the last puzzle, or what's the implications?
Maybe I'll speak a little bit about the way that I see that. I mean, no, I have no insight into what their next steps will be, but I've long said that the risk of overhang of regulatory action is, I think, maybe the final big boss, for crypto. And I actually think in some sense it's quite healthy that we're going through this now, because I think once that clarity comes, to Jason's point, I think it does enable a lot of different client segments to really ramp up their involvement. But in general, I actually think that the crypto space doesn't necessarily, I think that the underlying tailwinds for crypto are so strong that the space will flourish even in this uncertainty. Because if you think about the macro backdrop, we have 0% interest rates in major economies globally. And I almost think that's just the most important fact of all, whether there is this rush to yield and a desire to avoid a depreciating asset, which is a fiat that you hold. Almost everything else is secondary to that single fact. And what you find is folks moving down the risk curve. I think Dan mentioned this Dan from CMS mentioned this on your podcast, Michael, but you see folks moving down the risk curve from bonds to equities to VCP, VCP to higher alternative assets. And even if small amounts get into those alternative assets for a market cap, which is, 1.5 or $1.6 trillion, a couple of $1 trillion makes the space go 5 to 10x overnight. And I think that trend happens regardless, I think, of some of that regulatory uncertainty. So I think the tailwinds of crypto are super strong, but if crypto manages to, at the same time, get some regulatory clarity, I think things are very, very positive indeed. And I think that those are like the most important things. And I think we will find that regulatory clarity and those on the margin, those dollars seeking a higher yield will find their way to crypto. And so I remain incredibly constructive. That's how I see like the most important elements for our space.
I think that crypto is showing the insanity of trying to apply 1930s, 1940s regulation, right? Pre-TV, never mind internet, never mind smartphones, never mind cryptocurrency software, pre-TV regulation to this modern cryptocurrency decentralized system. And in the US, it's even worse because we have this kind of decentralized model of commodities regulation over here, securities regulation over here, banking regulation over here, money transfer regulation over here. And they talk, but not to the extent that I think everybody thinks they do. And so now the system is buckling at the seams because Bitcoin's a commodity, right? Ethereum maybe used to be a security, but now is probably a commodity. We don't know what NFTs are, at least by US standards. There's security tokens that this wrap stuff that, FTX is marketing outside the US. And so everybody is struggling. And the other challenge we have is these are shiny objects. So if you're a lawyer at a regulatory body and you have the opportunity to work on the next Bernie Sanders case or some crypto thing, you're going to choose crypto because it's the shiny object in the room right now. And so all of these things are happening at the same time. But what people forget is we actually do have reasonable clarity as to how Bitcoin and virtual currencies operate today. And, my opinion is on the one hand, we don't need to make this overly complicated, but the system that we already have from a regulatory perspective is unnecessarily complicated. I mean, compare the way our system operates, the way the Monetary Authority of Singapore operates, for example, where you can actually spend a week on it and understand how the system there operates. You could spend 10 years on our system and not really fully appreciate all the details of how it operates. I mean, we're overseen effectively by 70 regulators in the United States. It's untenable to appreciate the complexity of all of that, and it's getting worse.
So building on that for 1 second, I'd love to put this idea that gets espoused in our industry a lot to all of you and see what you think about it. Generally, there's this idea that kind of gets said in crypto, which is that crypto is a global phenomenon, right? Which is very true. And if you decide to be too draconian in your regulation, you're not going to regulate it away. The only thing that you're going to do is regulate away your seat at the table, so to speak. I'd be curious to know what you all think about that argument in general. Do you see it in a more nuanced kind of way? Like, what would some of the ramifications be of some of the largest economies in the world, the US, China, et cetera, kind of coming down with really draconian regulation?
Well, let's relate it to yield, right? So there's DeFi protocols, and then there's the services on top of DeFi where you log into a web page or download an app to actually access those protocols. Now, the Uniswap protocol can't really differentiate between anything that the US would consider a security or a commodity, unless some open source developers voluntarily change the code to do that, which I can guarantee you they're not going to voluntarily do. On the other hand, Uniswap, the company, whatever that means, can manually change their website to filter out trade assets or run liquidity assets that might be deemed securities. And they've done that. They've filtered out those assets. So we're already seeing examples where on that spectrum, the protocol, which we can say is decentralized, makes no differentiate between any asset types. And the company, which is centralized because there's an off switch, can actually filter out assets that some arbitrary government, in this case, probably the US, might deem to be, a security in particular. And so this is going to continue to be a problem as we have this kind of slow, methodical march towards true decentralization, which is several years away at best.
I think what you're going to find is that the countries that have clear regulatory standards will foster capital formation in those jurisdictions, and that the crypto space will continue and will tend towards those jurisdictions. And then in terms of the context of this debate about yield, you'll find what exists already, which is that you'll find some client segments in some particular geographies are only able to access certain centralized players. And then you'll find differing yields, which come about due to that differing regulatory environment, right? So folks that can face the CME may not be able to face other offshore exchanges, for example. That alone characterizes a lot of the business that, or some at least of the business that folks on this call conduct. So I don't think crypto goes away. I just think it changes jurisdiction, and you get new types of arbitrage and new types of opportunities appear. I think it's I think smart investors see that a little differently, though. I think a really smart investor looks at regulatory risk in a democratic society as a huge opportunity. Look at cannabis, look at crypto investors 6 years ago versus, regulatory risk in a totalitarian regime where on Monday they say miners are banned and on Friday they're all gone. Yeah,
okay?
No, that's,
so I think you're going to see.
And I think there's probably a few jurisdictions that sit in between, right? So for example, one of the things I like about, for example, in Asia, I think you'll find a lot of regulatory regimes that are actually quite clear and quite accommodative to crypto, and you can expect you have a very good understanding as to how the law will be interpreted. But I do think it's very difficult for regulators to regulate crypto out of existence. I think what you'll find is you'll just find capital moving to regulatory regimes that accommodate it.
Yeah, I agree with that. So, I agree with Leo's point. I think now it basically is a clear trend that regulation and is the only way to mainstream, right? Because eventually, however nascent this asset class is, after a few years or 10 years, 15 years, are going to be part of the existing incumbent financial system, going to be part of it, right? So the only way to be inclusive is to find a place in regulation that this whole activity can be regulated. So I think the countries who take a lead, the regulator who take a lead to form a clearer guidelines is going to command incredible like first mover advantage, let's say, put it that way. I mean, then the sizable companies will naturally move there, and then between them they form a more healthy ecosystem where a lot more derived activity is going to start to surface. But I also think it's a challenging job, as I just mentioned, no matter from which jurisdiction and regulator perspective, it's a new thing. So I do think they're going to the regulators are going to closely monitor each other. For example, what has been done and said in the US is probably going to be immediately discussed by the regulators in Singapore, Hong Kong. So I do think, even though the first mover is going to take advantage, but the second mover or third mover is going to come quite close to the first mover and push out something similar to that, because everyone is basically referencing everyone in this thing. So that's how I think about it.
You think about how all of our businesses are set up. I mean, we have offices around the globe. And we do that specifically to, one, engage with regulators, and two, unlock, the opportunities, to Bill's point, it's opportunity in a democratic universe. Like, that's what we're here to do. We're here to follow that, to engage with regulators, but also play by the rules in specific jurisdictions. And I think that's very important. And that's where the opportunity is, to be able to unlock that, to be able to deal with clients in Singapore as well as New York City. Right? I think you need to be able to do both things. And so it's very important to engage and also, have offices and appropriate, incorporations where they need to be.
Yeah, exactly. I agree with Jason. I think a platform like ours, like for example, Galaxy, Genesis, like Matrixport, Abra. I mean, once we set up a different office in different jurisdiction, actually we get some regulatory clarity in some jurisdiction. We're going to basically pass on that knowledge and to the other jurisdictions that we like in regulator will work with. So eventually, I think we become the conduits where some of these educations and also communications across regulators that could happen through the players like us that operate on global scale.
Yeah. I want to focus in on one kind of specific question for US-based regulation. And then we'll see, maybe we might have to end it there. But Bill, you brought up a pretty interesting point, which is this idea, it's a very different way of looking at the world, right? Which in the future, you kind of see this great demand to borrow in a depreciating asset, mainly being fiat currencies like the US dollar, and hold assets that are going to appreciate being in crypto. I also share the same view as you, right? That you can kind of view commercial banks as an extension of the government. That's a part of the system that actually creates those dollars, right? So there's this fundamental, how is this going to work from an incentive standpoint, right? Because there are a lot of advantages that accrue to the US as being the issuer of the global reserve currency, right? And commercial banks play a really, really key part in that money creation, right? If you're not going through the fiscal channel. How are we ever going to see them make the decision to essentially, not prioritize that? How are they going to give up that risk? Do you think it's just not going to be a choice for them, or how does that incremental change sort of happen in your mind?
I personally, I don't think it does. I think they die. So, look, I've been watching this since my Netscape days. Every single business on the planet has been transformed from the inside out based upon the internet, with a couple of exceptions, and the biggest exception being banking. And the reason for that is primarily the monopoly that they're granted by the government to effectively create and manage money. And that is basically being ripped out from under them without them even understanding that it's happening. And to that point, I actually predict that some of these large exchanges that are going public now, or could be going public, are going to start buying banks, not the other way around. And when that happens, it will start to hit home that these banks are in trouble, because people are going to want to bank this way in the future. They won't call it banking. They're changing their terminology, right? That's my opinion. It's going to take 10 years to play out. And in internet time, people don't realize, I mean, Netscape was 30 years, I think, but not necessarily tomorrow. Okay. So, it also relates to the question that I saw before. Somebody said, what's the difference between risk appetite in different continents? And my take is there's no difference. The only difference is what you have access to. It's not like people in Asia want to leverage themselves 20x, and there's no gamblers in the US that want to do that. Of course they want to do that. They're just shut out from doing it. And so I think what's going to happen with these decentralized systems is they're going to make it extremely difficult for governments to coordinate over time to basically shut consumers out from having the kind of financial services that they want. And decentralization force their hands to say, okay, yeah, as we basically move crypto, borrow, decentralize, borrow in depreciating assets and hold appreciating assets, maybe we can regulate at the edge. But beyond that, it's going to become more and more difficult for governments to have a role in that over time. In the short term, I completely agree with what Jason said before. We have to basically fully commit as centralized companies to be role that for now. That's have to change over definition. And so we're all basically trying to fit ourselves into the existing model for a system that doesn't want the existing model to exist. And so it's going to have to change over time. We just don't know how it's going to change.
Yeah. Guys, we have 2 minutes here, so I just want to be cognizant of time. But any closing thoughts or just anything to add? This has been a really illuminating conversation for me, and I'm sorry we couldn't get to more audience questions, but anything that you guys want to add in these last?
Maybe I'll just, I think I really enjoyed Bill's last point. What I could hear of it. I think that the fact that there is clearly a regulatory push in crypto right now is a great thing. I think the fact that crypto has been to some extent pushed out of China is a great thing. I think that the United States has a tremendous opportunity to be at the vanguard and at the forefront of the crypto asset space in the next 5 to 10 years. And I know that working with regulators and fostering and facilitating that is a key priority for us, and I'm sure it is for the rest of the panelists. And so I remain very excited. As I mentioned before, the underlying trends of creating a permissionless network and having a macro environment where folks are moving down that risk curve creates tailwinds that I think are, which are very difficult to overcome. And so, if we can proceed in that direction with the regulators on board, as I expect will be the case, then I think things look very constructive for crypto assets indeed.
Awesome. Hey guys, I'm really sorry, but unfortunately we have to wrap it there as we are at time. Thank you guys so much for taking part in this. This was a really interesting discussion. And again, a big thank you to the session sponsor, Matrixport, who made this possible. Again, a big congrats on the raise. That's no doubt why, Cynthia, you were on a beach today. But yeah, I highly recommend you guys all go check them out at www.matrixport.com. And folks who are still listening, if you're interested in this webinar, our next coming one is on August 19th. We're going to be talking about the intersection of crypto and finance. So maybe building a little bit on that last point from Bill. And that's going to be with CEO of LMAX Group, David Mercer, and Jay Biancamano, who is head of digital assets at State Street. Guys, thank you so much. We'll have to do this again sometime soon.
Great. Thanks.
Thank you for taking.
Thanks, man. Bye.